Hello everyone, I'm your host Kunal Sodhani from Global Trading Center, Shinhan Bank India. And what's happening with the markets? Too much of volatility which we are witnessing. Trump being the president now for the US, dollar index has been raising, Fed now concerned about inflation once again. Would there be more taxation cut? Would there be more tariffs imposed? Would there be immigration policies? On the Eurozone, if we see, it's about more dovish stance and they're looking for more rate cuts. While on the Bank of England, they are still fighting inflation and thus stabilizing on the interest rates. While on the Bank of Japan, we are seeing rate hike probability there. So too many ifs and buts and too many volatility infusing factors which we are seeing now. Now what is happening with rupee also? We are seeing an all-time low or weakening of the rupee now, and the dollar rupee pair is towards all-time high levels. So let's understand first, trying to deep down into what is happening with the global factors. So first, as we discussed about Trump, yes, now it's about the Trump trade. Trump is of the opinion of America first. So since 2016, when he was the president earlier, I think he was clearly of the opinion of reducing imports as well as promoting exports, and thus he started imposing tariffs on China. Later, obviously there were the propaganda which was there into the Trump's agenda was on three parameters, mainly on the tariffs, mainly on the immigration, and third on the taxation. It's important to understand one thing, that China has overtaken US as the largest producer, but it's also important to understand that now US still remains the highest consumer because the demand itself is huge there. So 90% of the global trades are still happening in US dollar. So obviously dependency on dollar still remains as a reserve currency. But as we discussed about the propaganda, first if we talk about the trade and fiscal policy, particularly on the tariff front, we have realized that Trump is getting displeased by countries where US runs trade deficit with. Like for example, US runs deficit with China, Japan, Germany, Mexico, Canada, and etc. So there he is not happy, and thus those are those countries where Trump is looking forward to impose tariffs on. While if we talk about the countries where they have surplus with, like for example Saudi Arabia or Israel, they are completely fine with it. So with the onset of Donald Trump coming on 20th of January, we believe that yes, tariffs will be imposed particularly on China. But what will China do? There are two things which China has done in the past. One, obviously having a retaliatory measure by weakening Chinese yuan, and second, they also imposing tariffs on the US exports. So this is an important element to consider. While second point is immigration, where immigration, I think Donald Trump has been very clear about immigration policies, and it will definitely affect the global trade flows at the end of the day. The remittances will definitely affected because of the immigration policy. So immigration will affect mainly the DM economies. Third, if we talk about a taxation, yes, there have been talks about a taxation cut, but I think it may not be that easy considering the fiscal deficit remains still on the higher front. So taxation cut may not happen. That's what our personal belief is. But because of these factors, what has been the thought process for the Fed? Initially, if we recall that yes, Fed was more dovish in terms of the interest rate cuts for the coming year. But because of Trump getting elected as a president and too much of uncertainties prevailing on the policy front, the dot plots which we have seen in the December policy states only 2 rate cuts for 2025. In fact, if we talk about this policy, which was the December policy, we did see a rate cut which was in line of expectations. But two important considerations are very important to know. One, there will be dissenting Fed members, because we have seen one vote against even this time where they had not voted for a 25 basis rate cut. Now, one important thing to note is there are 11 regional Fed president members, there are 7 Fed governors and the president of the New York Fed. Now the rotation happens in terms of the Fed voting members also. So in 2025, there will be 4 voting members who will be rotated into the committee now. Now they have different stance, and our belief is this dissent, which is of 1 member, may increase to more members in the coming policies to come. So it is quite important to watch and understand the behavior of the 4 members who are getting into the committee. So more dispensation will happen into the policy making in 2025. Trump policies will be obviously dictated, and we need to watch at least Jan-Feb month to understand in case of any changes in terms of the Fed trajectory. But if you ask about our projections, we project 3.4% as Fed rate by the end of 2026, and in the year 2025 we also project 2 rate cuts only. Now, because we are talking about China, we should also discuss something mainly about it. One, about the collapsing housing market, their sluggish equity markets. Irrespective, in the month of September they had announced stimulus where they wanted to boost more infusion of money into the system. They did that. We saw a rally into the equity stock market, but then it all fell down again. So they are struggling there. Consumer activity or the demand is still less. Aging population is also disturbing them. So there are too many ifs and buts for even China in terms of the growth trajectory. So we believe that Chinese economy still will hold on in terms of more fiscal spending, because somewhere they need to think about how this fiscal plan should play, because monetary policy may not be that effective in terms of reviving the Chinese economy back. So drawing this down and trying to understand what are we expecting in our dollar index. So first, because of too much uncertainties, we have already been seeing since the election results, the dollar index has been bullish. So dollar index, our view remains 104.70 acts as a very important support, while we see that there is huge scope of dollar index moving towards 112.20 levels also. Similarly, when we are also projecting about how the Fed will behave in terms of the rate trajectory, as we already stated that 2 cuts for 2025 and the terminal rate moving towards 3.4% by 2026. If we plot it down to the 10-year US Treasury yields, our anticipation for the first quarter remains 4.25% on the lower end, while 4.93% on the right side. We have seen these levels. Now, if there's a drying of the interest rate cuts, I think the yield may further rally, which is already on the right side. Now, as we discussed about Chinese yuan, it's also important to understand how this currency will be faring. So, if we talk about the dollar CNH pair, we anticipate dollar CNH pair having a support at 7.19 levels, while 7.36 is the near highs, which has been extremely crucial. In case if we see this breakout, then obviously there can be more pressure on or more weakening on the Chinese yuan front towards 7.5 levels also. But let's move on to what's happening with the Eurozone, where Eurozone, as expected, did cut their rates by 25 basis points. So their deposit facility rate is at 3% and refinancing rate is at 3.15%. But they are struggling and they have been quite dovish, because there have been certain members who have been even talking about a 50 basis rate cut in the policy which was given as 25 basis. So going ahead, it sounds quite dovish. Growth, there is a problem that they're struggling. Investments are drying up. In fact, even in terms of the jobs, there are problems. Factory closures are a problem. Public debt has been on a rise. If you talk about the public debt, it has gone almost double in terms of the last 7 years. To put it into numbers, I think it should be around from 2 trillion euros. Now it is moving towards 3.2 trillion euros. Even the fiscal debt has gone higher, more than 100 billion euros. So there are too many factors to consider from the Eurozone. Even the French politics cannot be ignored, where Le Pen is also trying to make a comeback. Though the presidential elections and the elections for the Eurozone at large are in 2027, but you never know, the way French politics works, things can change in next year itself. So to sum this up from the Eurozone, their focus might remain more on growth. Dovishness may still prevail, and they may consider maybe 4 rate cuts for the year 2025. So from the deposit facility rate at current 3%, we are anticipating by the end of 2025 it to move towards 2%. Now, what we draw for the euro-dollar pair? Yes, euro has been under pressure. Dollar has been bullish across currency pairs, across G7 and Asian currencies. So we expect 1.01 levels acting as a very important support zone to act. Yes, people are talking about parity, but for us at this point in time, 1.01 acts as a strong base, while the immediate resistance comes at 1.0780, followed by 1.0960 odd levels. Let's move on to the UK. As we already discussed in the initial part, that they have been struggling with the inflation factors. This policy, we did not see any kind of rate cut. Their rates still remain at 4.75%. But the voting pattern was different. 3 members voted for a rate cut out of 9 members. So there still remains a dispensation and dissents even there. CPI still remains moderately higher. Mainly the focus remains on the services inflation, which is still at 5%, which is huge. It's also important to understand how the UK businesses will react or behave when it comes to the employer's national insurance contribution hikes, which may come in April 2025. Plus, the Trump policies will obviously be seen before taking any kind of decisions. So for the UK, we anticipate 3 rate cuts for the year 2025. We anticipate the rate going towards 4%. And in terms of our view for the GBP dollar pair, we anticipate 1.2280 to act as a support, while 1.2860 to act as an immediate resistance. But if this resistance is broken out, then 1.3010 levels can be tested. Let's move on to the other economy, which is more of a concern and more of a divergence, which is Japan. And we talk about the Japanese interest rates. So the Japanese interest rates were held steady at 0.25% in the policy. There was dissent by one member who had voted for hike by quarter basis, but obviously we had the status quo overall in line with expectations. But if we talk about their wages have been growing fastest since November 1992, and that is one of the reasons the economists have been pushing and thinking of a rate hike which may come maybe in the coming policies. Also, why did not they give this rate hike this time is maybe they want to watch more data points. They also think the domestic economy is not strong enough to at least withstand any kind of rate hikes at this point in time. The CPI number still remains above the target zone of 2%. And that's the reason maybe the BOJ governor did not say anything about the rate hike trajectory, which was at least anticipated in this policy. But going ahead, as per our in-house view, we believe that we may see one rate hike in the first half of the year by Japanese economy. But one thing to note that we have seen the hikes in the past, and we have seen maybe carry trade unwinding is the right word to say. If this happens, we may further see unwinding and we may see dollar JPY pair moving below 150 again. So overall trajectory for us in terms of our technical view remains 145.5 remaining as a support, while on the other hand, if we talk about the resistance level, 162 has been the near highs which may be tested before even the policy rate hike happens. If only we break those levels, 164 is the new channel highs which can be tested. So that's from the global perspective which we have covered. It's now important to understand and draw down that what is happening in the Indian economy and the domestic front. So if we talk about the trade deficit numbers, the trade deficit numbers for the month of November came into the tune of around $37.84 billion, while it was around $27.14 billion a month ago, that is in the month of October. Now, what's the reason this trade deficit has risen a lot? If we talk about the exports, they have increased by merely 2.17%, while if we talk about the imports, they have increased almost by nearly 8.35%. Amongst the imports, if we talk about the gold imports, they have risen almost to the tune of $14.8 billion, vis-a-vis almost double, as we can say. In October, it was around $7.13 billion. So the gold imports have been a major concern, due to which this trade deficit for India has widened. Also, if we talk about the petroleum products exports, they have declined a bit as compared to the previous months. So the export remains a concern also. But what do we eye on the current account deficit? We anticipate current account deficit for India to be at 2.8% of GDP for the quarter ending December. So this will be at almost 2-year highs, we can say. Let's move on to understand flows, because flows remain a quite important element when it comes to dollar rupee pair, which is a developing currency. So if we talk about the FPI flows for the month of October and November have been negative. For the month of October to the tune of 94,000 crores, and for the month of November almost to the tune of 21,000 crores. Purely outflows from equities has been seen. For the month of December, we have been still lucky. We have been having an inflow to the tune of 18,000 crores till December 27th, 2024. But if we draw down this line towards annual 2024, then the inflows in equities have been flattish to the tune of maybe 3,200 crores. While if we talk about the inflows in the debt fund, they have been tremendous to the tune of 1,12,000 crores. Overall, if we also add the hybrid inflows along with the equity and debt, the overall inflows for the year till December 2024 has been to the tune of almost 1.69 lakh crores. So which is a decent inflow altogether, because that has been a major contributor to it. But if we also understand after the FPI flows, the FDI flows, the gross FDI inflows has been to the tune of almost around $48.4 billion, which earlier so this is the tenor from April to October. Same tenor last year, it was around $42.1 billion. But if we talk about a net FDI number, they has decelerated to the tune of around $7.7 billion to now decelerated to $2.1 billion. So almost a deceleration there on the net FDI front, mainly due to the repatriation plus because of the net outward FDI flows. Now let's move on to the FX reserve part, because that has been quite interesting. We have touched almost $704 billion of FX reserves, that is the all-time highs. After that, in the couple of last months, we have seen it depleting towards $652 billion now, so almost a depletion of $50 billion, mainly attributed towards the revaluation of the FCAs, that is foreign currency assets, and also because of the intervention which we have been seeing because of the weakening of the rupee by the central bank. So these both contributed to the depletion of the FX reserves, but still we are at a very decent level of FX reserves considering our import cover. We're still at more than 11 months of import cover. On an average, the longer tenor of import cover has been to the tune of 10 to 11 months. So we are decently above that. Secondly, even if we talk about the external debt outstanding, we are still 96% covered via our FX reserves. So that's a healthy sign considering even the weakness in the Indian rupee. Yes, we may see some more FX reserves being depleted considering any kind of sharp weakness or volatility into the INR. But I think that may not impact us, because the way we have grown in the last couple of years from $450 billion to $704 billion, it may not matter that much in terms of the depletion of the FX reserves. Now moving towards the CPI, because that will define how the RBI policy may take ahead. So if we talk about the CPI numbers, that did cool off to the tune of 5.5% from 6.2% in October. If we talk about the food inflation, they have also cooled off to 8.2% from almost 9.7% in October. The core inflation has also cooled off to 3.7% in November from 3.8% in October. Even if we talk about the rural inflation and urban inflation, they have also cooled off 6% and 4.8% respectively. Our trajectory for the inflation remains that food inflation may cool off in the coming quarter, so Jan to March, and we anticipate that the CPI number will be sub 5 now. So overall, we anticipate 4.8% as our CPI inflationary target, which seems to be under a comfort band. So I don't see, at least in the next quarter, CPI should be a concern. But growth numbers, on the contrary, if we see, the growth numbers were shocking. We saw a number of 5.4% for April to September quarter. Now the anticipation itself was almost around 7%. So the consumer activity has dropped. Investment definitely was a concern. We also discussed about exports on the global share has been dropping to 2%. Wages, the urban wages particularly, has been being sluggish and taking some hit. So there have been some issues, but going ahead, our concern does not remain more on the growth front, considering the Kharif output has been healthy. Erratic climatic conditions are fading away, and also because the Indian budget will be announced in the month of February, some kind of stimulus will be seen which could be boosting the growth at large. So our anticipation in terms of the growth trajectory remains quite positive. We anticipate growth for the next quarter to be around 6.5%. On an annualized basis for FY25, we still anticipate around a growth of 6.6%. Yes, though global growth may take some hit, but I think we may end up on an average of 6.5 to 6.6% on the growth trajectory. Now we have drawn the line both from the inflation as well as on the growth side. Let's understand what is expected from our policy, that is the RBI Monetary Policy. The RBI Monetary Policy is on the Feb 5th to 7th, where the anticipation in this policy itself was a CRR cut, because liquidity tightening was a very major concern, due to which they did cut CRR by 50 basis points in two-phase manners, which infused liquidity to the tune of 1.16 lakh crores. But possibly that isn't enough considering the GST and the advance tax outflows. So in terms of the liquidity for the coming quarter, Jan to March, we still think the liquidity may remain tight. Thus, this CRR cut was essential, yes, but I think going ahead, it also gives a signal keeping a neutral stance. Plus the voting pattern was 4-2, which means two members did vote for a rate cut in December policy as well. So we believe, yes, there are chances for rate cut. Yes, a lot of things may depend on the Trump policy, which may unveil starting from Jan 20th. But we see that one rate cut may be expected in the first half of the year. That's what our projection is. Overall, on an annualized basis, we expect 2 rate cuts from the RBI as well. Now let's draw this line towards how do we see dollar-rupee pair faring. We are already seeing all-time high dollar-rupee pair. Considering, first I'll just share our view. We anticipate this weakness to persist for some more time, considering the dollar bullishness to prevail. Also, it's important to understand how the Asian currencies have behaved. So if you talk about from November, since the Trump has won the elections, from then the Asian currencies has depreciated almost around 2.5 to 5%. But if we talk about the rupee, we have only depreciated by nearly 1.39%. So we have not depreciated that much to the tune we have been speaking about. So ultimately, if the Asian currencies start depreciating or weakening, rupee cannot be sidelined. Though RBI has been intervening at intervals, but this intervention may remain shallow, because if Asian currencies start depreciating, I think rupee will also depreciate, which we are already witnessing to some extent. So our view overall remains that rupee may weaken for some more time. We have seen depletion of FX reserves. Any opportunity on the lower levels may be picked up even by the central bank to build in the FX reserves once again. So broader range, what we are expecting is 84.5 on the lower end, while 86.20 on the right side. That's a broader range play for the first quarter. Also, if we talk about the RBI bulletin, the RBI bulletin clearly highlights that RBI has been net short by $9.3 billion in the month of October bulletin, which has been released recently. But if we also count the short position of RBI, adding the intervention which was in the futures market, NDF market, considering both onshore and offshore, the overall short position comes to almost around $46.9 billion. Now this remains a concern, that how does this short position of $46.9 billion will fare year from, because it can have a dual impact. If things go wrong, it can go worse for rupee. We may even see sharp depreciation above 86.20 also, in case if this position gets more tighter. So it's important to understand how the intervention has been faring. A lot of paying interest has been seen recently. If you see the forward premiums, the forward premiums have been on the rise. So it's almost risen from 1 year annualized, almost from 2% moving above 2.3% now. So it's a very fast move because of the arbitrage opportunities which have been prevailing into the market. There has been NDF which has been quoting at a premium since the Trump trade, and onshore market, that is the OTC market, is at discount. So a lot of paying interest has been seen in the onshore market, due to which also there remains pressure both on spot as well as on forwards, while the arbitrage opportunity is being captured across tenors. So it's important that RBI initially was doing a lot of buy-sell swaps, and once these buy-sell swaps were over, it remained open for this arbitrage opportunities, because suddenly these buy-sell swaps were off the market. So this created more arbitrage opportunities, which have been creating more pressure on the rupee at large. What do we suggest an importer as well as an exporter? So first, talking about an exporter, these are obviously, it's a win-win situation, both in terms of the spot rising higher. Also, if we talk about the forward premiums, they have been moving higher. So both are acting in the favor of an exporter. But yes, you cannot catch a top or a bottom. So I would recommend that the levels of around 85.40, 85.5, one should hedge 30% of their exposure, with keeping their another exposure open with a stop loss of 85.05. On the other end, if we are able to see levels of 85, 80, 86 levels, we should add furthermore 20% there and remain open for the remaining 50%. While if we talk about the importer, yes, they have been struggling on both the ends now. But for an importer, we have been seeing levels of 85, 85, 20 in interims. So if we are able to see those levels, one should hedge at least 40% of their exposure to those band which between 85 and 85.20. And it's important to keep a mental stop of 85.60. In case if we are able to breach those levels of 85.60, one should add another 30% there and wait for any cool off or any kind of massive intervention if seen there. And also how the policies may frame out, considering the policy framework coming in by Trump. But one important highlight which no one is speaking of is what are we discussing here is all in the inflationary picture, where whatever Trump has been saying or what was the propaganda earlier, but what if these things doesn't turn out? Because the cabinet will also have Elon Musk as a part, which has been announced. The major exports or the major supply of goods for Elon Musk is also China. So you never know that things may not turn the way we are thinking too negative. If things don't fall the way which the global economy has been thinking in terms of tariffs, taxation and immigration, then we may see a sharp cool off as well. So this angle should not be missed. There has been side talks between US and China even now, where some positive comments may be expected. So one needs to keep these stops very clear, because markets are like God. You cannot predict what he's expecting or what he wants for you. So similarly remains the dollar rupee pair as well as the dollar index at large. Broadly, again summing it up, the final stop for an importer should go 85.60. And on the lower end, if we are able to see levels of below 85, somewhere 84.70, 85 band, then at least 30-35% can be added. So massive chunk should be added at those levels because we are not seeing any sharp appreciation, at least at this point in time. So I really hope the broader band is very clear, 84.5 to 86.20 for the first quarter. Well, that's all from my side. Hope you found our analysis useful. In case of any feedback or any queries, you can get in touch on the below mentioned mail ID gtcindia@shinhan.com. Once again, I'm really thankful for your time. I'm your host Kunal Sodhani from Global Trading Center, Shinhan Bank India. Thank you so much for your time and watching us. Thank you.